Well, joint forms of property holding between husband and wife have been widely used among farm families because of certain supposed advantages, one of which is the simplicity of transferring property upon one's death. Well, Roger McEowen with the Washburn University School of Law joins us now for a deeper look. And as always, Roger, thank you very much for your time here today. So what are some of the basic principles of joint tenancy?
Well, Janet, good to be with you this morning. A distinguishing characteristic of joint tenancy, of course, is the right of survivorship. And so that means that the surviving joint tenant or tenants, if there are more than two, become the full owner or owners of the jointly held property upon the death of a joint tenant, regardless of what that deceased person's will might say. Now, of course, I'm talking about common law property states. There are some community property states across the country. And so this discussion is, you're basically already there in those states, but this discussion is for those in the other states. So you have to state, however, that you are intending to create a joint tenancy. You have to say with rights of survivorship, and that's a key feature that distinguishes a joint tenancy.
Are there any benefits when it comes to the tax treatment of a joint tenancy?
Well, there can be, but again, the estate plan has to dovetail in with the way that you title your property to get those benefits. And the reason I say that is we've got a really high exemption right now, the highest ever from estate tax at $12.06 million. And we also have a basis step-up rule. So if we cause inclusion in the deceased joint tenant's estate of that property, then the surviving joint tenant gets a fair market value basis as of date of death. Now, if it's a non-spousal joint tenancy, anybody other than mom and dad, then we use a 50% rule, a consideration furnished rule, and well, it could be 50%, but it's whoever bought the property to the extent they paid to the purchase price for the property, then that extent proportionally of the value at death is included in that tenant's estate. So if you had a brother that bought 100%, paid 100% for the property, put sister's name on it, and brother dies, sister's going to get a full step up in basis at his death. And if it's under the 12.06 million, then there's no estate tax on it. If it's a spousal joint tenancy, that's where it's 50% in the first spouse's estate, and then the survivor has the full property. So it could create a problem. You get half taxed in the first estate, full taxed in the second estate if you don't do it right.
Are there any special rules that we need to keep in mind moving forward, and do you have an example?
Yeah, this is a big deal. If you have an older joint tenancy, let's say you bought farmland before 1977, and this is because of a rule change that Congress did, and it's by spouses only. So if you have a pre-77 marital joint tenancy, then the consideration furnished rule applies. And so if dad bought the farm, say in 1975, and it was worth $250,000 at that time, and now dies and it's worth $2.5 million, it's all in his estate because it's a pre-77 joint tenancy. Still under the $12.06 million exemption, let's say, his whole estate is under that level, so no estate tax. Now mom owns the property by the survivorship feature, and her basis for tax purposes is $2.5 million. So you get the benefit of both worlds in that example if you plan it correctly.
All right. Well, Roger, as always, thank you very much for your insight today. Roger McEowen with Washburn School of Law connecting with us. You can go online to washburnlaw.edu/WALTR for more information.